Okay, so the first question is below some company's overhead rate was based on the estimates of $189,600 overhead cost, and the direct labor hour is 18,960 hours. Below some standards allow 2 hours of direct labor per unit produced. Production in May was 840 units, and the actual overhead incurred in May was 19,000. So the overhead budgeted for 1680 standard direct labor hours, the cost is $16,500. And the breakdown is 4740, that's the fixed cost. The remaining 11,760 is the variable cost. So the question is to ask how to calculate the total overhead variance, the budget overhead variance, and the volume variance. So that's the question. Okay. So what is the total overhead variance? Okay. What's the total overhead variance? So total overhead variance is when you compare the actual overhead cost versus the overhead applied. Okay, the overhead applied based on standard cost driver units. Okay, so this is the driver units allowed for the amount of units produced. Okay, so it's easy to know what's the actual overhead cost, but what is the overhead applied, right? The overhead applied in this case will be based on there are 840 units produced, and by standard, how many cost drivers, in this case, is the direct labor hours. So how many of that direct labor hours allowed, okay? So it's based on that direct labor hour, right? So in this case, we can calculate the predetermined overhead rate. So we were given company overhead rate was based on this cost number and this total direct labor hours. So you use division, you figured out the predetermined overhead rate is actually $10 per direct labor hour. So now, what is the overhead variance? So you use actual overhead minus overhead applied based on the direct labor hours allowed for the actual output. So actual overhead cost is 19,000. So this information is given. And the actual output is in May is 840 units. And then each unit's 2 direct labor hours allowed. So times 2. And then for each direct labor hour, the predetermined overhead rate is $10. So therefore, I calculated the overhead variance is 2,200 unfavorable. Okay, so this is how I calculate the total variance. Okay, does this make sense? If you understand this, please give me a thumb up. 1, 2, 3. Give me a thumb up if you understand this. Okay, awesome. Does anyone have any question? No? Okay. So next, we're thinking of calculating just give me a second, overhead budget variance. What is overhead budget variance? So you compare your actual overhead versus your budgeted overhead, right? So you compare your actual overhead with your budgeted overhead. So in this example, in this question, the actual overhead is $19,000. The budgeted overhead is $16,000. $1,500. Okay, so the difference is $2,500 unfavorable. So now let's take a look at the volume variance. Okay, volume variance. So what is the volume variance? Okay, so let's take a look at this picture. You can see when you think about the overhead variance, it can be break down into two components. One is called a variable overhead variance, okay, and the other one is the fixed overhead variance, okay. So under variable overhead variance, you have variable overhead spending variance and variable overhead efficiency variance. Under fixed overhead variance, you have fixed overhead spending variance and fixed overhead volume variance, right? So when you talk about the volume variance, you are speaking of the fixed overhead volume variance. So a variable overhead volume variance does not exist, right? Whenever you are speaking of overhead variance, volume variance, you mean the fixed overhead volume variance, okay? So now you take a look how this fixed volume variance is calculated, right? So here you are using normal capacity hours at standard fixed overhead rate, right? Normal capacity hours. So in this example, the normal hours is based on 18,960 hours per year. Okay, so you can see the normal capacity is $18,960 directly per hours. Okay, so that's annually. In this question, we are dealing with the month of May. So then the capacity for each month will be calculated by dividing this number by 12. Okay, so then I figured out actually the monthly budgeted labor hours should be 1,580 hours. This is based on the capacity, right? Based on capacity. And then I know the cost for the month, the fixed overhead cost for the month is $47.40. So I can figure it out. My predetermined fixed overhead rate is $3. So therefore, when I'm calculating my volume variance, the middle column here for the fixed overhead is the 1,580, right? The total annual capacity divided by 12. This is my monthly capacity. I multiply it by the standard rate, $3 fixed overhead per direct labor hour. On the right column, this is the hours allowed, right? So basically, you are making 840 units in the month of May. And according to the standard, each unit will require 2 direct labor hours. So I'm using 840, that's the actual output, times 2 hours per unit. I get what is the standard labor hours allowed for the actual output. And then I times the predetermined fixed overhead rate, $3. So when I'm comparing these two, I have a $300 fixed, $300 favorable variance. Okay. All right. So if you understand the way how I calculate volume variance, please give me a thumb up. 1, 2, 3, thumb up. Okay, so Do you have any question? If you didn't give me a sum up, do you have any question? Which part confused you? You wish me to go over again? Do you have any questions about this question, this problem? Okay, let me check on the chat. Some people. Yes, this slide has already been posted on the canvas. It's under final exam. Okay, so if you go to your canvas, under the last module, the final exam, you can see that PowerPoint there. Could you explain how the volume variance is favorable? Yes. So why is favorable? Okay. So what happened is every month, right, according to the annual budget, the normal capacity for each month, the working hours, is 1580 direct labor hours for each month. The actual this hours here, okay, you can see they were able to make 840 units times 2. So the standard direct labor hours allowed for this output is $1,680, 80 hours. So 840 times 2, you get 1680, right? So you compare 1680 to 580. So actually, for that month of May, you have more direct labor hours capacity available. You have $100 more, right, available. So then you times 3 the rate per direct labor hour. So that's the $300, right? You have more hours available, right? So that is a favorable variance, okay? That is a favorable variance. Because normally, with that amount of fixed or with that amount of budgeted cost, the more hours you are able to use, it's better, right? So if I have a classroom, right, the rent is the same, the electricity is the same professor will come here to teach, right? So all these fixed costs are the same, right? And according to the capacity, the seating capacity, let's say it's 75 students in the classroom, right? But now I'm able to squeeze in 85 students into that classroom, right? So I have the same cost, same fixed cost, right? But my capacity increased in that month, right? So that's the good news, right? That's good news for me, right? I can squeeze more students into the classroom. That's a good news for me. So it's favorable. Does that make sense? Manjot, does that make sense? Okay, awesome. Thank you, Manjot. Okay, does anyone else have any question? Okay, I will move on. Then the same student was asking me to go through question 7 on the assignment, chapter 11 assignment. Okay. So in this question, it's asking you, it's basically help you to understand the relationships between different terminologies, right? So Sandhill Company had the following results during the most recent year. Sales, $436,800. Residual income, $3,640. Investment turnover, 2.4. and a required rate of return 16%. Okay. So the first question is asking you to calculate the total asset, right? So this is important, right? You have to be able to, this total asset is unknown. This is the number, this is the factor we are trying to figure it out, right? In order to know that, you have to make linkage between total assets with the information given, right? So in the question, you know sales information, you know residual income, you know investment turnover, and the required rate of return, right? So right away, I'm able to make a linkage between total assets, sales, and the investment turnover. So why is that? So your investment turnover, by definition, equals sales divided by total assets. Okay, so then, right, this is the three factors. If I want to solve my total assets, so my total assets will equals sales divided by investment turnover. And both information are given. So I use that two number. I figured it out. My total asset is $182,000. Okay, so that's the first step, how I figured out my total asset. What about my operating income? Okay, what about my operating income? So I figured out operating income by using residual income and total assets. So what is the relationship? So by definition, residual income equals operating income minus total assets multiplied by required return, required rate of return. So then I want to figure out my operating income. That equals my residual income plus total assets times the required rate of return, which is 16%. We know the information for both residual income and total assets, which we just calculated in the first question. So I'm able to figure out my operating income equals 32,760. Okay, so that's my number two. Number three, calculate the return on investment. So what is the return on investment? Return on investment equals operating income divided by assets. So in question two, I learned about what's my operating income. In question one, I learned about what's my assets. So the dividend tells me the return on investment is 18%. Okay, it's 18%. And the last, calculate the profit margin. So profit margin equals operating income divided by sales. Sales is given, operating income is calculated in question two. Therefore, my calculation tells me that the profit margin is 7.5%. Okay. If you understand this question, please give me a thumb up. 1, 2, 3, thumb up. Okay, very good. Okay, this is very good. Okay. Does anyone have any question on this? You can see that the key to answer this question is to understand how these different factors, terminologies are connected with each other through these formulas, right? Okay, I will move on. So this is a question from a student. So this student sent me a PDF with a list of 4 questions, okay? So let's see the first question. So the first question is about standard cost. So in this case, you're going into business, making and selling pies. Your recipe consists of the following. There are different materials: crust, meat, vegetables, broth, spice, herbs, and the quantity, standard quantity required. Okay. So you just have to be careful. What's the standard quantity for each ingredient, each material, and then you have the standard cost. Okay. So you estimate that 10% of the meat and the vegetables will be normal spoilage. What is the standard cost for direct materials per completed pie, right? So this is a fair question. So basically, I want to know for each completed pie, what would be the standard cost on the materials? Okay. The information on the table is the recipe for pie. Okay. So the information on the table is per pie, right? So now you calculate the cost, right? So I have 2 pieces of crust. Each one will be $2.49. So 2 times 2.49. You have 1 kilograms. You need 1 kilogram, right? But you actually have to increase that to be 110%, because 10% will be the normal spoilage, right? So 10% will be the normal spoilage. So therefore, you use 1 kilograms times 110% times 5.95 per kilogram. The same idea for vegetables, right? Is this also subject to 10% of the normal spoilage? So 0.25 kilograms times 110% times 2.6. And then for broth, okay, make sure you do not use 250 times 1.95, because here you have to be careful about this standard cost. It says 1.95 per 200 millimeter. So I'm going to only add 1.95. And last is the 15 milliliter times 0.07 per milliliter. So when I did my calculation, my result is $15.24. Okay, does this make sense? If this makes sense, please give me a thumb up. 1, 2, 3. Okay, good. Does anyone have any question? Okay, didn't see any question. Let me go for the next question. So in this question, it's asking ABC company sells product PC13 at a price of $40 a unit. The per unit cost data are direct materials, $12, direct labor, $11, and overhead, $12. And it's saying 75% of the overhead are variable, okay? ABC Corporation has sufficient capacity to accept a special order for 20,000 units, but at a discount of 20% from the regular price. So selling costs associated with this order would be $2 per unit. Determine the ABC Corporation whether they should accept this special order. Okay, so let's take a look. So I'm comparing the two alternatives. One is called accept, the other is called reject. Okay, and then I would compare the two, see how that would increase or decrease in net income. So I'm comparing accept to reject. Okay. So if you reject that special order, you don't get any money. You didn't do work for them, so your revenue is 0. But if you accept that special order, the cost per unit is actually the regular price $40, right? That's the regular price. And there is a 20% discount. So I would times 80%, right? So this special order price will be 80% of the regular price. So $40 times 0.8. So the revenue per unit is 32. However, your direct materials, that's your cost if you accept the order, that's negative 12. If you reject the order, there's no cost on direct materials. Labor, negative 15, negative 11, 0. Variable overhead. Variable overhead is 75% of the total overhead cost. Right? Total overhead cost is actually $12. 75% of that is $9. Right? So your variable overhead is $9, and your fixed overhead is the difference between 12 and 9, so it's $3. Remember, if it's a fixed overhead, right? So even if you reject order, your fixed overhead is still there. So you cannot eliminate that fixed overhead cost, right? It's going to be there. So, so the cost is -3 for accept, and reject for -3 as well. And there's a selling cost per unit, $2. You don't have this cost if you reject that order. So now I can see that by accepting this special offer, my revenue per unit will increase 32. My cost will be direct materials 12, direct labor 11, variable overhead 9, and the selling cost 2. So when I add everything up together, I have a negative $2 loss per unit. Therefore, I can't accept this offer. Does this make sense? So let me see. Give me a thumb up if you think this makes sense. 1, 2, 3. Okay, thank you. Does anyone have any question? Why is there no spoilage for pie crust or broth? That's just based on the information from the question. Yeah, I agree with you. In the real life, there may be percentage, right? But according to that question, the assumption is there's no spoilage on the crust or broth. Yeah, you could calculate it without the chart, right? So at the end of the day, you have to rationalize what's happening, right? Eventually, you would tell me that if you take this special order, you're going to lose $2 per unit, right? But if you don't follow this format, that's fine. You don't have to always follow this format. Okay. So the next question is about whether to process it further. Okay. So in this question, Shini Minerals processes materials extracted from mine. The most common raw materials that it processes result in 3 joint products: stucco, backroll, and lacquer. Each of these products can be sold as it is, or they can be further processed further and sold for a higher price. The company incurs joint costs of $180,000 to process one batch of the raw materials that produced the 3 joint product. The following cost and selling price information is available for one batch of each product. So you can see I had on the table, I have the 3 different products on the rows, and on the columns, I have a selling price at a split off point, right? So if you remember when I was doing a lecture, right, we are talking about a split off point. At that point, that different joint product become independent, right? So you know the selling price at those split off points, and then there is the allocated joint costs. There are the cost further processed, and there's a selling price of the processed product, right? So the question they are trying to decide is whether to sell this product now, or you want to process it further and sell the processed product, right? So in this case, we can see that we first want to think about the benefit of further processing, right? By further processing, I would have more revenue. So there will be incremental revenue. So the way how I calculate the incremental revenue is I take the difference between the revenue of processed versus the revenue of unprocessed, right? So for example, Sarco, the revenue price of processed product is 310,000, but unprocessed is the price is 200,000. So I take that difference, I get a $110,000 incremental revenue, right? So this is basically the benefit. What is the cost, right? It doesn't comes free for that processing, right? So you can see Starco, the processed cost is 100,000, okay? So that's my incremental cost. So my incremental revenue is 110,000. My incremental cost is 100,000. The incremental profit is 10,000, right? So 10,000. So therefore, the answer should be, okay, I should further process Starco. Using exactly the same approach, we can figure it out that Barco, the incremental revenue is $9,000 below the incremental cost, right? Therefore, it's not worthy of pursuing further process Barco. For Larco, we know that the incremental revenue is 300,000. The incremental cost is 250,000. So there is a net profit of 50,000. Okay, so the answer to this question, should you sell or you should further process? It's really depending on the product. For Starco and Larco, they should pursue that further processing. But for Barco, no, yeah, because you are losing money by doing that. Okay, does this make sense? If you think this makes sense, please give me a thumb up. 1, 2, 3. Okay. Does anyone have any question? Okay, let me ask you a question. In my solution, I use this selling price at the split off point. I use the selling price of processed product. I use the cost to process further. But I didn't refer or use any of this information allocated joint cost. Can you use 2 words? Tell me why these costs are not used. Allocated joint cost. Just 2 words, okay? Just answer me 2 words, and right away I will know you got it. So why the allocated joint cost are not part of that calculation. Anybody wants to try? Thank you. Yeah. So the farmer dealing is correct. These are the sunk cost, right? This cost happened. This cost happened before the split off point. Okay, so this, remember, you have a joint process. You have a split off point, right? The joint cost happened in that common process right before reaching that split off point. So now we are talking about going forward from the split off point. So those joint costs are irrelevant. They happened in the past. You cannot, change it. So this is the joint cost, the sunk cost. Okay, now move on into our last question. So let me see. This question is a little bit long. I will give you 5 minutes to read it, okay? So I don't want to read it for you. I want you to spend some time to read the question carefully, and then I will review the answer with you, right? So I will give you maybe, let's see, 5 minutes. I'll give you 10 minutes to read this question carefully, okay? Okay, do you have enough time to look into this question? Okay, so let's do this together. So this company have a 5-year contract to supply this company, North Plain, with 4 specific spare parts for its fleet of airplanes. So the 4 parts are A10, A20, A30, and A40. So the table have the information about their selling price and the cost, contribution margin, and the production in units. Okay, and also how many machine hours required by each unit. Fixed overhead cost is 820,000, and the company have a maximum annual capacity of 6,000 machine hours, right? So this is their constraint, right? The machine hours is their constraint because the maximum capacity right now is $6,000 machine hours. So the first question is asking, if this company could manufacture only one of the 4 parts, which spare part should it produce based on the contribution margin per limited resource? Explain why. So in this case, what is the limited resource, right? In this case, we just talked about the limited resource is the machine hours. Okay, so the idea is if you can only make one of these 4 component, which one you are going to make, right? So basically the idea is we need to maximize our contribution margin per based on the limited resource, right? So towards that, we need to calculate what's my contribution margin per limited resource. So this is how we do it, right? So we calculated total contribution margin using revenue minus variable cost. And then I know the number of units for each component. I'm able to calculate my contribution margin per unit. Okay. And then I also know the number of machine hours required for each unit. So then I can calculate what's the contribution margin per unit per machine hours. Okay, so then you can see that the highest number is from A20, and then it's A40, and then A30, and A10 is the last, right? So my ranking is 4132, right? 4132. If I can only manufacture one, I would pick A20 because for each machine hour, that's the limited resources, the contribution margin per unit is $450. Okay, $450. So does this make sense? If this makes sense, please give me a thumb up. 1, 2, 3. Okay, yeah, good. Thank you very much. So that's the first question. The second question is asking another airline. Okay, we talked about this contract is between the company and the North Plain, but another Polaris airline wants to buy 200 units of part A10. So this Polaris airline wants to buy A10. They want to buy 200 units of A10, and they are paying 110% of the price. Assume that for any of the 4 parts, okay, so this company has to supply North Plane, so the existing supplier. They have to supply at least 90% of the number of units specified in the contract, right? You have a contract specify that you have to supply at least 90% of the of the number of units specified in the contract. Okay. Should Sharp, this company, accept the order for 200 units of parts A10? Show your calculations. Okay. So this is my calculation. Okay. First, I want to see if there is enough sufficient capacity, right? Because my machine hours is a limited resources, right? If I need to take additional offer, the first thing I want to check is, do I have enough machine hours? Okay. So if I take a look at my machine hours, I have number of units, okay, for each component, and then the machine hours required by per unit. So for example, for the component A10, right, you supply 1,000 units, each unit requires 2 machine hours. So therefore, the 2,000 machine hours is required, right? And then I did the same calculation for A20, A30, A40, and also this is the additional offer in the consideration. So 200 units times $2, 2 hours per unit. So that's the 400 hours. So now if I add them up, if assume I still keep supplying North Plane at the same level, and then with the addition of Polaris, the 400, together I will need 6,325 hours. Okay, but the capacity is only 6,000, right? So this tells me that the company does not have sufficient capacity to supply North Plane, right, at the regular level, and at the same time accept Polaris special order. And now the consideration would be, well, since we allowed to supply only 90% the level to North Plane, right? Doesn't have to be always 100%. So it's still okay according to the contract if we supply North Plane at 90% of level. So therefore, what about we cut the production on the units for North Plane so we can release some machine hours, okay? So this is our consideration. We need, right now, okay, there are 6,325 hours. Current capacity is 6,000. So we are short of 325, right? We are short of 325 machine hours. So how can we get this 325? So my consideration first is to which one to cut first. So my ranking is 4, 1, 3, 2. So A10 would have the lowest contribution margin per machine hour. So I would consider to cut the production on this. But remember, the maximum of the reduction is only 10%, right? So if you reduce 10%, you still keep at least 90% to meet the requirement of the contract. So if you cut 10%, so for A10, 2,000 hours, if you cut 10%, So you want to cut 200 hours, right? So 325, now you release the 200 hours by cutting on A10. So you still need an additional 125 hours, right? So now let's go with the next one. The second lowest contribution margin per direct machine hour for 3 is the A30, okay, for A30. So the total machine hours right now is 1125. So again, if I cut 10%, so that would be 112 hours, 0.5 hours, okay? So now 125 minus 112.5, I still need further release of machine hours of 12.5 hours. So I have 4, 3, and now 2, right? Now 2. So that's A40. So A40, each unit requires 5 hours, 3 hours. So to make 12.5, if I cut 4 units, 4 times 3, that would be 12. That's still not enough. If I cut 5 units production, I get 15 hours. So that's enough to cover that shortage, right? So that's what actually is going to happen, okay? Let's take a look, okay? So I'm going to reduce 200 hours on A10, 11.3, because it's 112.5, but it's just makes sense to get a full hour, right? So 113 reduction for A30 and 15 hours reduction for A40. And we have calculated the contribution margin per machine hour. Okay, so we can calculate what's the loss of contribution margin for each component. So in total, we lost $57,175 contribution margin because we have to cut down the production on the north plane. The benefit is we take that order. That order for the Polaris order, they are ordering 200 units, A10, and each A10 will require 2 hours. So in total, we are having 400 machine hours. And we calculated the Polaris order contribution margin per machine hour is $207.50. So this will give us an increase of contribution margin of 83,000. Right? So by taking Polaris order, my contribution margin will increase by 83,000, but we have to give up the contribution margin from that you would have earned from North Pole in the amount of $57,175. So the difference is a net income, right? 25,825. So the order should be accepted because you make more money, right? Some students will ask me, how did you get $207.50 for the new order? Okay, so they told us this one, they want to buy at 110%, right? 110% of the price. So this is how I calculated. So the A10 here, right? The A10 here, suppose the price would be here, okay? So if you take a look at here, the sales is, regular sales would be with the North plane is 1.5 million on 1,000 units, right? So that tells me that that selling price is 1,500 per unit, right, to North plane. Okay, so if that's 1,500 per unit, that's the selling price, but they're paying 110% more, right? So this is the price they're paying Polaris order. And you are going to minus the variable cost is the same, right? The variable cost is the same. Okay, so therefore, your contribution margin per unit is this. Okay, that's your contribution margin per unit. Remember, for each unit, there are 2 machine hours. Okay, so then you divide by 2. So your contribution margin per unit per machine hour is 750. So that's 1500 divided by 2. And 1235, that's 617.5. So this calculation tells me my contribution margin per unit per machine hour is $207.50. And because we are Polaris are purchasing 200 units, each unit are 2 hours. So total we have 400 machine hour times contribution margin per machine hour. So that's how I get my 83,000. Okay. All right. So does this make sense? Just give me a second. Okay. If this makes sense, please give me a thumb up. If this makes sense, please give me a thumb up. Okay, thank you, Manjot. Thank you. Okay, so if you don't understand, can you please ask a question? Okay, does anyone have any question on this? So I didn't see any question. So I will move on. So part 3. Okay, part 3. A new technology is available that cost 2.5 million and would increase sharp this annual capacity by 25% should the company purchase the new technology. So their capacity was 6,000 machine hours, right? And this is going to increase that capacity by 25%. Assume the technology has an estimated life of 4 years, and the company can sell at the same price paid by North Plain all the unit it can produce of any of the 4 parts. Show your calculation. Okay, so your current capacity is 6,000 machine hour. And with the investment, you're going to have 20% more. So you times 125%. So your new capacity of machine hour would be 7,500, right? So now you have a current contract with North Plain Company, right? With North Plain Company. And I calculated the total machine hours required is 59.25. So I have some capacity available even after completing the contract with North Pole. So that capacity is the difference, 7,500 minus 59.25. So my capacity left is 1575 machine hours. Okay, so if I need to use that machine hours, if I need to produce any of the 4 component, I will produce the one with the highest contribution margin per machine hour, which is 820. For each unit of 820, they require 4 machine hours. So I use total machine hours divided by 4. I figured out what's the number of A20 units can be produced. So 393. And I know the contribution margin for each unit. Okay, that is the $1,800. So I can calculate what's the total contribution margin. Contribution margin will be earned 393 times 1,800. This is my total additional contribution margin earned, and this will be earned, over a 4-year, right? Over a 4-year equipment life. Okay. So this one times 4 years, each year you have 707,400, right? And then multiply that by 4 years, it is, so the total contribution margin over 4 years is $2.8296 million. Your investment, the cost is only 2.5 million. So therefore, you have a net positive revenue here, 329,600. So therefore, this is the good strategy. They should buy the new technology. Okay, if you understand this question, the answer to this question, please give me a thumb up. 1, 2, 3. Okay, does anyone have any question? Okay, so this is all the questions the student asked. Okay, so if you don't have any other question, okay, I see some question. Where does the contribution margin 1,800 per unit come from? It's from the first part of the question. Here. So for this one ranked number 1, A20, you can see the contribution margin per unit is 1,800. So it is from the calculations in the previous sub questions. Any other questions? Any other questions? All right. Okay. So that's it for today review section. If you have any other questions, please feel free to send me email. And remember, our final exams is coming soon. So that's going to be August 6th, right? So good luck with your study.